It's almost like they've done an about face, quietly, not in your face, but if you look and research the same way you and I do, you see it. You may not see it watching Jim Cramer or watching Fox News yet, but you will begin to see it. Even they are talking about the debasement trade. You're hearing that on mainstream. You're seeing Walmart and Costco sell gold and not be able to keep it in stock. It's beginning to become more accepted. But when you see the U.S. government, Nomi Prince did a great job in writing about what's going on in the repo market. I'll try and sum it up for you if I can. Something is happening in my mind beneath the surface of the financial system because over a 5-day stretch over the last 2 weeks, the Federal Reserve injected $125 billion into the repo market, and the popular talking heads would say it was to ease funding stress, as we saw in 2019 with the repo market problems, in 2008 with the fail of Lehman Brothers and the great financial crisis. But it's important to understand that $125 billion, especially over a few days, over a period of 5 days, is akin to crisis-like behavior. It's on par with what we saw when Lehman fell. It's on par to the 2019 blowout in the repo market. But let's first kind of try and dumb down what the repo market is. It's the plumbing of the financial system. And it's where banks, big banks, lend to each other overnight, literally overnight. And they do this to keep things flowing, if you will. Normally, this market, you never hear about it, and that's what it's supposed to be. It's quiet. It means everything's working. But when the Fed steps in with huge amounts of cash, mind you, typically, if there's no stress, you won't see much of any movement in the repo market or usage of it. If there's a little bit of stress, you might see 3, 4, 5 billion put into it or trading in it. If there's moderate stress, maybe 10, 12 billion. At 125 billion, it's the equivalent of hearing loud banging noise every time you turn your water on in the walls. Something's not right. Something's not flowing right. But what makes this concerning and very different than what we saw in 2008 and 2019 is that in 2008 and 2019, it was an issue of liquidity or lack thereof. Now, this is not a we're out of money problem. Today, the big banks that would trade in the repo market actually have twice the reserves that they had during the 2019 repo crisis. And in this environment, the Fed would rarely, if ever, inject liquidity into the overnight market when reserves are this high. In this environment, repo injection should be near zero because the banks have enough money to trade with one another back and forth. It's just overnight exchanging collateral, typically Treasuries, sometimes mortgage-backed securities or whatnot. But this isn't about money. It's about trust or lack thereof. And in essence, then again, banks are looking at each other and saying, not a chance in the world am I going to borrow anything or lend anything to you, or not even for one night. And because I'm not sure you're going to pay me back tomorrow morning. And the reason this matters is because you typically only see repo market stress right before market corrections. And that's an ominous sign. It's an ominous sign in that this is all about the lack of trust. And when the most well-informed traders on the planet, the very, very large commercial banks, are saying, you know what, I'm not lending my money into this system. I'll just park it at the Fed instead. I am not going to do it. And you start to see the overnight lending system dry up. It portrays, I think, serious fractures within the entire system and is far more concerning than just a lack of liquidity. It's a lack of trust, which is far more systemic and troubling.
Unlike past repo disruptions driven by cash shortages, today's tension is rooted in mistrust. Large financial institutions, despite holding more than double their 2019 reserve levels, are refusing to lend to one another, even for a single night. Institutions are increasingly uneasy about the quality of collateral offered or the stability of counterparties. Repo injections should be minimal in such a high liquidity environment. Yet the Fed is stepping in aggressively. This breakdown reflects a psychological fracture. The most informed players in the system are choosing safety over participation. Historically, This kind of behavior precedes broad market corrections and systemic cracks.
Yeah, so I mean, the banks are trading with other banks, smaller, regional maybe, and also with large hedge funds. And you know, um, even though you would think that this would be something that should be easy peasy, it's not. And because now it's a lack of trust, it's also a lack of faith in collateral. We've been seeing a lot of subprime and mortgage-backed securities, not subprime, but mortgage-backed securities rather, used as collateral. Now you would do that after you've already, I mean, you're doing that because you don't have treasuries or you don't want to trade your treasuries. You're trying to give the collateral that is less than perfect, so they don't trust the collateral and or they don't trust the partners. That is not a good thing because you're trading overnight. You're talking the most liquid, safe, secure trading platform on the planet. You can't get more conservative than trading overnight with the big banks and using a collateral that is, either mortgage-backed securities, which are bundled, or the treasuries. And this portrays that the system itself is rotting from underneath. And the big players know this. It's concerning for sure. And I think people should keep a close eye on it.
The shift in collateral quality adds another layer of risk. Banks have begun offering lower-grade securities, bundled mortgage assets instead of treasuries, indicating they're either reluctant to part with high-quality collateral or short on it. That signals deteriorating confidence in the plumbing of global finance. Parallel stress is emerging in the precious metals market. As delivery deadlines approach for gold and silver contracts, pricing structures show unusual behavior. A rare backwardation in silver suggests immediate physical demand outweighs future expectations. This historically emerges before major price moves and often indicates tightening supplies, elevated risk perceptions, and heightened skepticism toward paper markets.
So I think we're either 9 or 10 days away from where holders of the December gold and silver contracts have to, it goes into delivery at that point. I think it's the 28th of November. This is where you could say instead of the rubber meets the road, it's where paper meets physical. Those who want to stand for delivery can on the 28th. They don't have to do it on the 28th, but this is when typically they'll declare, yes, we're going to stand for delivery. And when you look at gold right now, it's business as usual. You have spot right now. I looked this morning. It was like $1.60, I think, over the December futures contract. And that is classic contango, right? And so you have the futures price is going to be and it's actually under the December futures contract. Spot is about $1.60 under the December futures contract, which is classic contango, which means the further out you go, you're supposed to pay a higher price, and that takes into account things like storage, interest expense, the cost of money. So in other words, if the spot was 4,100 an ounce, it would be 4101.50, something like that for the December futures contract. As we get much closer to the end of the contract, when you can stand for delivery, it should get narrow and get closer to 1-to-1. The further out you go, the larger that contango, the larger that interest expense, the larger the cost of storage. That's normally how it works. So if you go a year out, it may be $25 an ounce more because of the cost of money, the cost of interest, and the people who are betting on it says, yeah, it's going to be $25 higher in a year. That's contango. Backwardation is something you don't see in the metals market very often. It's where the spot price is over the futures price, not under like gold and contango and normal market, but over. And that's backwardation. And it's rare, especially this close to expiration. What it basically says is someone wants physical silver now, not later, and that they see tightness in inventories and immediate demand is outpacing the expected supply. In other words, I don't care what the futures say, I will pay more for it today. I don't want to give you, kind of like what the banks are saying. I don't want to wait one day. This is, I don't want to wait anytime at all. I want it right now. And this kind of spread, especially as we get close to expiration, doesn't happen unless something's off. And it usually comes right before a big move in the metals market. So I think it's interesting to see, this is what we've been talking about for a long time. Now, for a minute, we saw the market when 50 plus million ounces found their way to London. We saw the market shift from big backwardation as much as $3 an ounce to contango, as it's supposed to be, lasted not more than a day or two, if that. And now all of a sudden we're back in backwardation again. And that just simply says a lack of trust. And this is a theme we see everywhere, whether it be the leaving or the dumping of treasuries by countries like Japan, who has its own problem right now with the $110 billion stimulus package that they're throwing out because the yen is collapsing to a 35-year low. But you're seeing it with, the world doesn't trust our treasury market anymore because of fiscal irresponsibility and sanctions like we did to Russia. And Trump saying a 500% tariff if you support Russian energy purchases. Well, that's not a tariff, that's a sanction. They don't trust us. The banks don't trust each other. And now the exchanges, the players within the biggest exchanges on the planet don't trust each other to the point where they say, nah, I'm going to pay more for it right now than I will for it in the future. That is backwardation. That, again, the theme is no one trusts each other. And that's a problem in a world where everything is based upon trust. And if the trust is eroded, if your wife cheats on you, how long does it take for you, if ever, to get that trust back? Now, that's a bad analogy, but the point is the same. We are a country, we're the good guys. We were based on, a moral high ground and doing the right thing. And you could argue whether it be the constant political bickering, whether it be, the way the world looks at us, being in Iraq, yet passing judgment for 22 years, mind you. We're still there. We never found the weapons, but the way we passed judgment on Russia. Now, I'm not making making a statement on either, but I'm just saying the world looks at us as being hypocritical. And the treasury market, based on trust, with massive fiscal irresponsibility and countries wondering if they're going to be the next one to be sanctioned, everything seems to be eroding in terms of trust. When trust in institution, in currency, in the judicial system, even all the way up to the Supreme Court. Look at what's happening on the Federal Reserve. We don't trust them anymore either. We're finding the members of the Federal Reserve are doing illegal things that we would go to jail for, but they just get fired from the Federal Reserve. It is a lack of trust across the board, and that is not what strong economies and resiliency is born from. In fact, quite to the contrary. To me, it is far more discouraging and threatening to this system than just about anything else.
The repo market's fractures mirror a global trend, a widespread collapse in institutional credibility. Foreign governments continue reducing Treasury holdings, reflecting concerns about sanctions, U.S. fiscal discipline, and political polarization. Japan, facing its own currency crisis, has begun selling Treasuries to stabilize the yen. Simultaneously, geopolitical tensions and policy inconsistencies weaken global confidence in U.S. leadership. Domestically, trust in government agencies, courts, and even the Federal Reserve is deteriorating as scandals and accusations pile up. When the world's reserve currency issuer is perceived as unreliable, every layer of the financial system feels the tremor. Trust, not liquidity, is the failing pillar.
I think, again, it's all, you could argue that it is symptomatic, emblematic of how empires collapse. And lack of trust is right at the top, along with governments overspending, then borrowing to cover the gap. The central banks come in and print to keep it all going. The currency weakens as a result. And what does the smart money do? They move into hard assets. What have we seen across the globe by the central banks? Oh, they're moving into hard assets. What are the Chinese doing? Moving into hard assets. Who gets crushed every time? The middle class. And then the system resets because mathematics demand it. And along the way, you're going to see the rot come up from the bottom. And who are the winners in all of this? they're the ones that are always closest to the money printer or the information. That is the Cantillon effect. And that is the people closest to the information and closest to the money benefit disproportionately because of all of the money printing. These people, they know the information, they buy the assets before everyone else figures it out. They're closest to the money, meaning they have a lot of money and they're able to take advantage of the inflation. They buy assets, their assets go way up, and the rest of the world, the middle class, gets creamed. Right now, 75% of U.S. households cannot afford a median price house in this country. And the median age for a first-time home buyer is now 40 years old, the highest on record. And so when you talk about the American dream, it's slipping away because of this rot. And I think as this problem accentuates, you'll see much more of this. We've already seen 2 or 3 of the members of the Federal Reserve, be kicked off, or the second one right now is, or the third one right now is under investigation. But this is, look at what's her name, Nancy Pelosi, and evidently Paul Pelosi is the greatest investor on the planet. And all of these things are happening, at a time where things are systematically changing. I think you should expect to probably see a lot more of it. And that's just the way cycles repeat. And unfortunately, I think, read the book, The Fourth Turning, we're getting to that point where every pillar of trust in American life, government, media, medicine, law enforcement, the Federal Reserve, the Supreme Court, it's all unraveling. And, the system's authority, to your point, is eroding from within. And I would say that, the moral authority that I mentioned, we were the good guys who rebuilt the world and championed democracy, but that moral high ground is disappearing, done again, and it's undermined by hypocrisy. And we're a preach a rules-based order while breaking those same rules ourselves and punishing other nations for actions we take too. The world notices, and the people up in the government who break the promises and break the rules, well, they just get slapped on the wrist and move along. I think the world is no longer buying the story. And I think that's what this is all emblematic of all over the place, whether it be the banks, the institutions, government, or, the people running the show on all levels. That's a problem when the whole gig is based upon trust and no one trusts us anymore. It's not a good thing.
Periods of financial stress often expose long-standing structural weaknesses. Today, the burden falls heavily on the middle class, which is priced out of housing, squeezed by inflation, and left out of asset appreciation cycles. Meanwhile, institutions positioned closest to the flow of new money, the classic Cantillon effect, accumulate real assets early and benefit disproportionately. Central banks worldwide are quietly stockpiling gold at record levels, signaling preparation for a possible shift in the monetary order. The U.S. has even reclassified silver as a critical mineral, while China restricts exports, tightening global supply. Wealth is migrating from paper promises to tangible stores of value.
Oh, that's an easy one. It's like a softball as far as I'm concerned, because look at the highest levels. We've talked about Michael Harden at Bank of America saying 25% gold. We've talked about Jeffrey Gundlach, the bond king. 25% in gold is not overweight. We talked about the chief investment officer for Morgan Stanley, 20%. Sell half your bonds instead of 60-40 gold, silver, 60-40 stock bond. He said sell half your bonds and put 20% in gold. Now, we've never seen that before. These are people talking to the institutional clients at the highest level. Look at all the importing of gold into the country since last November. Billions and billions and billions and billions and billions of dollars worth. Who's doing it? I'll tell you who's doing it. People who know the playbook. People who don't do things just for the heck of it. Look at the fact that the United States not only has just classified silver as strategic metal, look at the investment by the United States government in the resource sector, in the mining companies, taking positions in some of these big companies to build strategic stockpiles of critical metals. In other words, the things that you and I have talked about for a long time that we were mocked at because, well, Wall Street would never recommend even 5%. Now they're saying 25% is cool and not overweight. Look at the fact that the government, who would have thought you would never have thought the government, who we talk about the antithesis of the dollar, they are now embracing gold and silver, calling it critical, importing it. Judy Shelton telling us it's going to be tied to the bond market in less than a year. You look at all of these things and you say, is it gotten to the point where they've realized that things are going to change, that we are in the midst of a new monetary system a la the Genius Act, and that indeed it is about he or she who owns the commodities wins, and there's no sense in hiding it any longer? It's almost like they've done an about face, quietly, not in your face, but if you look and research the same way you and I do, you see it. You may not see it watching Jim Cramer or watching Fox News yet, but you will begin to see it. Even they are talking about the debasement trade. You're hearing that on mainstream. You're seeing Walmart and Costco sell gold and not be able to keep it in stock. It's beginning to become more accepted. But when you see the U.S. government call silver a critical mineral, you have now put policy and national security as a floor under the price of silver. And then China pushes back as maybe the largest exporter in the world, says, you know what, every ounce of silver that comes out of this country has to get permission and permitted through Beijing. That's going to massively slow down exports. You can see it everywhere. I think this time largely is different. Beware of the guy who says this time it's different. I realize that. But I think it is different this time. And you can see it by the pivoting from the most well-informed commercial banks and speaking to their institutional clients, all the way up to the government, all the way up to the draining of the world's exchanges, and the people who are standing for delivery on COMEX, on the LBMA, and on the Shanghai Metals Exchange. These are not just normal Joe and Jane citizen. These are the most well-informed and well-funded traders in the world who know what's coming and are front-running, positioning themselves before the herd. It's becoming different every day. Little by little, as we often say, little by little, and then all at once, I think is very appropriate right now.
Across markets and institutions, a common thread emerges: fading trust. Whether in government narratives, financial instruments, international alliances, or the stability of the currency itself, confidence is weakening. History shows that declining trust often marks the late stages of an economic cycle. As nations compete for resources and reposition portfolios, gold and other hard assets reemerge as anchors of stability. The world may be entering a new monetary era, one where transparency is scarce, volatility is elevated, and preparation matters. What comes next could reshape global finance, and the signals are becoming too visible to ignore.